Holistic Plan presents Tax Time with Jeff Levine. Let's talk taxes.
Hello everyone, Jeff Levine here, and it is great to be back with you. With our time together today, I wanted to talk a little bit about Social Security income, and more specifically, the taxation of Social Security income. You know, Social Security income and the benefits that an individual receives from Social Security are taxed in a really interesting way. If an individual's other income is low enough, then all of the Social Security benefits they receive will be 100% tax-free. By contrast, for those with higher incomes, as much as 85% of Social Security benefits can become taxable. So, at the end of the day, Social Security is a pretty tax-efficient form of income in that, at a worst-case scenario, only 15 cents on the dollar are still being received tax-free, and that's not really the case with much of anything else. I mean, most IRA distributions are taxable dollar for dollar. Interest is taxable dollar for dollar, etc. Your paycheck is every dollar of pay you receive is taxable in general. So the fact that 15% of Social Security benefits at worst are tax-free is actually a pretty good deal for taxpayers. Nevertheless, the formula for Social Security and determining how it is taxed, in which we have to come up with a calculation for income known as provisional income, or sometimes referred to as combined income. In short, it's Social Security AGI, which is your AGI with a couple of additions and subtractions associated with it, plus half of the Social Security benefits that one receives. That amount is considered provisional or combined income. It is then compared to two statutorily defined amounts, so two amounts that are hard-coded, if you will, in the tax code, called the base amount and the adjusted base amount. You don't need to know that they're called the base amount and the adjusted base amount. You just need to know there are these $2 amounts. For married couples, the base amount is $32,000. For the adjusted base amount is $44,000, and for single filers and really all others, it's $25,000 as the base amount and $34,000 as the adjusted base amount. And effectively, you just kind of compare provisional income to these levels, and you follow certain formulas. I'm not going to get into the nitty-gritty formulas here because that's not the point that I want to make sure that people are aware of. What I want to do today is highlight a unique phenomena that occurs with the taxation of Social Security income. In short, it's something called the tax torpedo, the Social Security tax torpedo. And what it is in effect, it is a marginal tax rate that is dramatically higher in some cases than an individual's stated tax bracket. You know, so many times when we're looking at individuals and projecting out their future taxation, we're just kind of saying, okay, how much income do you have? What tax bracket will that fall into? That's not good enough. The tax code doesn't work in that simple a way. Anything you do on the tax code kind of has impacts in one area or another, and Social Security is kind of a great example of that, where in some cases, when you take another dollar, let's say, out of an IRA, if you're already receiving Social Security benefits, that dollar you just took out of your IRA may be taxed at $1.85. Now, not literally, the dollar of IRA income is not literally, we don't just say like, okay, well that's $1.85. No, but what happens is because of this wacky Social Security formula, for every dollar you might add of real income, you might also have to then add 85 cents of Social Security that wasn't taxed before and now becomes taxable. And doing this effectively, by hand or in one's head is really, really difficult. In fact, this is where it really becomes necessary to use tax software of some kind to look at what happens as you take money out of an account. It might make you do things that you didn't think you would do. For instance, maybe you project that someone will be in the 10% bracket in retirement, but they're in the 12% bracket now. And so you don't do Roth conversions. Well, what if in retirement they're in the 10% bracket, but they really end up with a 18.5% tax rate? because they're paying tax on $1.85 at that 10% rate for each dollar they really receive. Again, it's complicated. You don't have to know all these details. You just have to know how to spot this. And the best way that I know how is using tax software that can look out multiple years. And so with that in mind, I want to turn it over to my good friend Ben Birkin, who can share with you some of these interesting nuances and some of the wild peaks and valleys in marginal tax rates that we can see when individuals are both receiving Social Security benefits and have other income as well. Might cause you to make a Roth conversion when you didn't think you would, or perhaps not do one when you thought you might. Many other impacts too, such as when you should harvest capital gains or not. So many things there. Again, Ben is going to show you some really good examples that we see within the Social Security arena, and how using tax software like Holistiplan can help you identify these areas to reduce your client's overall lifetime tax bill. Ben, with that, over to you. Take it away.
Thank you, Jeff. This is Ben Birkin, Vice President for Client Success and Engagement at Holistiplan. And for the next couple of minutes, I'm going to use the Holistiplan scenario analysis tool to illustrate some of the concepts Jeff was just talking about in terms of the taxation and taxability of Social Security income. I've already pre-built a scenario in here for a potential retiree couple where their income, at least for this particular 2021 baseline case, exists of just some tax-exempt and taxable interest, some dividends, and then their Social Security benefit of $27,000. Holistiplan will do the calculation for you to determine how much of that is taxable. So all you have to do is enter the gross amount. We'll calculate the taxable amount. If you wanted to follow line by line how we got there, you can pull up the little calculator icon, which references you back to IRS publication 915, page 7. But right now we can see that with this particular situation, about $49.75 of that Social Security benefit is taxable. Now, you sum all this up and you have a pretty low income year for the client because so much of that Social Security benefit isn't being subject to taxes. And at first glance, if you looked at this, you might say, well, I've got a 10% marginal bracket. This is a great year to do a Roth conversion and potentially pay very little in taxes. But with the benefit of the Holistiplan system is to make you say, wait a minute, if I do that, and I remember Jeff's words of wisdom that say, hey, some of this might be subject to taxation if I increase my income. By clicking on the range calc button, you can actually see the thresholds where you start pushing some of the Social Security income that hadn't been being subject to taxes into the realm of now being taxable. And you see that right here with this purple wedge shaped box right here. That's the torpedo that Jeff is talking about, where you have to consider not just the marginal rate on additional ordinary income, but the fact that you're now pushing income that hadn't been taxed because it was Social Security and that complicated formula that Jeff references, it's now being taxed. So that your true marginal rate, once you start adding about $11,000 of ordinary income, is a rate of 18.5% in this particular case. And it bumps up a little bit when you get over this threshold where we move from the 10 to the 12% bracket. Now you can also see what this looks like in terms of dollar terms. I've got a scenario pre-built that I'll bring in from our scenario bank that looks at the same exact formula, but instead we now also had a $20,000 Roth conversion. By adding that $20,000 of ordinary income, you take that gross benefit that had been being taxed at a very low amount, and now we've got almost $21,000 of that benefit is now subject to taxes. So just by adding $20,000 of Roth conversion income, we've actually increased our income by way more than that, right? Because we now have to factor in that additional income, a higher AGI, higher taxable income, and a higher tax bill than you might have otherwise guessed if you just added $20,000 of income to somebody who was in the 10% marginal rate. Hope this has been instructive. Hope you find additional uses to use Holistiplan to illustrate some of these more complicated concepts where words alone won't do them justice. And we hope you're getting value out of being a tax hero for your clients.